Hello, ladies and gentlemen. Welcome to my commentary today. The emergence of China's digital yuan marks one of the most consequential and least discussed shifts in the global financial order in decades. For the first time since the creation of the SWIFT network in the 1972 seconds, the world's dependence on a US-centric payment infrastructure is being seriously challenged by a sovereign digital alternative. And this challenge is not arriving with fanfare or ideological declaration. It is unfolding quietly, practically, and with a technological efficiency that reveals how much the global financial landscape has changed. At its core, the digital yuan is not simply a new form of money. It is a new settlement architecture. Transactions settle in a matter of seconds. No SWIFT messages, no correspondent banks, no intermediary jurisdictions where funds can be delayed, scrutinized, or blocked. For decades, global commerce has been routed through a chain of Western-controlled gateways. The digital yuan creates a direct sovereign-to-sovereign channel that bypasses them entirely. This is not a theoretical capability. China has already begun using its digital currency for cross-border payments with partners across Southeast Asia and the Middle East. In doing so, Beijing has built the first functioning example of a non-Western, instantaneous, globally interoperable payment system. It is an innovation that many in Washington did not expect to see emerge so rapidly. The logic behind it is abundantly clear. Countries engaged in trade with China, now the world's largest trading nation, have a growing incentive to settle transactions in a Chinese system that is faster, cheaper, and politically insulated from the volatility of U.S. financial policy. The appeal is not ideological, but structural. China offers speed, it offers certainty, and it offers a system that no external power can freeze or sanction. Even more significant is the emerging institutional adoption. The infrastructure was initially built for government agencies and major state banks, but in recent months, China has begun licensing commercial firms that help ordinary businesses settle cross-border transactions using the digital yuan. This means the system is evolving from a state-only platform into a broadly accessible global payment network. The geopolitical implications are profound. For decades, the US dollar's role as the world's reserve currency has rested on more than economic strength. It has rested on control of the global financial rails. Whoever controls the rails controls the flow of capital. And whoever controls the flow of capital exercises extraordinary power over diplomacy, development, and conflict. China's digital yuan represents the first credible effort to build a second set of rails, not to overthrow the old system, but to give nations a choice. In this sense, the innovation is less a direct challenge to American leadership than an acknowledgement that the global economy has outgrown a single point of financial authority. What makes this moment historic is its quietness. No political speeches, no confrontational rhetoric, just a functioning system offering speed, sovereignty, and security in a world increasingly defined by financial risk and fragmentation. The shift toward digital multipolar finance has begun, and digital yuan is its opening chapter. Russia's embrace of China's digital yuan is not an act of ideological realignment. It is the predictable consequence of a financial system that has become increasingly weaponized. Over the past decade, the United States and its European allies have turned sanctions into a central instrument of foreign policy. Entire national banking systems have been blocked, sovereign reserves frozen, and global corporations pressured to sever ties with targeted states. The effect has been to discipline adversaries and to push a growing coalition of countries to seek alternatives. No country has been driven into this search more forcefully than Russia. Since the invasion of Ukraine in 2022, Moscow has faced the most severe sanctions package imposed on any major economy since the end of the Cold War. Russia was disconnected from SWIFT, its central bank assets were immobilized, major commercial banks were excluded from dollar and euro payment channels. Whether one agrees with these policies or not, their effect was unmistakable. They demonstrated that global finance, long advertised as a neutral system of commerce, could be turned into a political instrument overnight. For Russia, the digital yuan offers a lifeline and, more importantly, a path towards strategic autonomy. The ability to settle trade with China, its largest commercial partner, without touching the Western-controlled infrastructure is a matter of economic survival Energy exports, industrial inputs, and critical imports can now be processed through China's digital architecture with immediate settlement and immunity from Western oversight. This is why Russian institutions have moved swiftly to operationalize the system. The Russia-China Friendship Committee is now actively training Russian businesses to use digital yuan-based cross-border payment channels. Major Russian commercial actors are opening accounts in Chinese banks, integrating settlement software, and adapting internal accounting to accommodate digital yuan flows. These are not symbolic gestures. They are deep structural adjustments within Russia's economic ecosystem. Meanwhile, Russia's own attempt to create a sovereign digital currency, the digital ruble, is progressing slowly. The technology is less mature, regulatory frameworks remain incomplete, and domestic banks are still adapting. Yet Moscow sees a clear future, a dual currency digital settlement environment in which Russian firms can use either the digital yuan or the digital ruble to conduct foreign trade. The long-term vision is a world where Russia is independent not only from Western payment rails, but also from Western currency dominance. The broader consequence is geopolitical rather than merely financial. By adopting the digital yuan, Russia effectively enlists itself as a foundational partner in the emergence of a Eurasian payment bloc, a network that reduces the influence of Washington and Brussels over cross-border flows. Importantly, this shift is not confined to Russia. Many countries observing the sanctions on Moscow have drawn their own conclusion: if reserves can be frozen, once they can be frozen again. If banking systems can be unplugged from SWIFT overnight, then no nation is truly sovereign within the existing system. In the moral and political landscape, this should be a moment of reflection for the United States and Europe. Sanctions can punish wrongdoing, but when used excessively, they erode the very trust that upholds the international system. Russia's pivot toward the digital yuan is less a rebellion than a recalibration, a search for certainty in a world where old assurances no longer hold. The result is unmistakable. A new financial architecture is emerging, born not from ideology, but from necessity, and Russia has become one of its earliest large-scale adopters. The accelerating cooperation between China and Russia in digital payments is not an isolated development. It is part of a far broader, deeper shift underway across the global economy. The gradual diversification away from a world in which the US dollar is the unquestioned fulcrum of international finance. This does not mean the dollar is collapsing, far from it. The United States maintains extraordinary economic power, deep capital markets, and unmatched institutional depth. But the era of exclusive dollar centrality is giving way to something more plural, more regionally balanced, and more technologically diverse. One of the most important drivers of this shift is trust erosion. For decades, countries held US dollars and used US payment systems because they trusted the United States to protect the neutrality of global finance. That trust has weakened. The freezing of Russia's foreign reserves in 2022 was a watershed moment, not because it punished Russia, but because it signaled to the world that the reserves of any country could be politicized if geopolitical tensions escalated. Nations across Asia, Africa, the Middle East, and Latin America began quietly reassessing the risks of total dependence on the U.S. financial architecture. Meanwhile, economic gravity has shifted. China has become the largest trading partner for over 120 countries. The more integrated these economies become with China, the more natural it is to explore payment channels that bypass the frictions of dollar settlement. In Southeast Asia, cross-border digital yuan trials are now routine. In the Middle East, energy exporters have begun experimenting with ECNY transactions attracted by the speed and predictability of China's digital infrastructure. Even in Africa, where digital financial innovation is rapid, several countries are studying how central bank digital currencies could interface with Chinese systems. Another driver is technology itself. The world is moving toward digital, instant programmable money forms of settlement that do not require swift messaging or correspondent banking networks. The dollar's dominance was built in an analog era. Digital currency infrastructure is rewriting the rules of settlement. China's digital yuan is the first major example of a sovereign digital currency used in real-world international commerce. Others will follow. The European Central Bank is exploring a digital euro. India is building its own digital rupee architecture. Gulf countries are testing blockchain-based settlement rails for oil and gas transactions. In this emerging landscape, the dollar will remain immensely important, but it will coexist with alternative systems. This coexistence reflects a deeper geopolitical reality. The world is no longer organized around a single axis of power. Regional blocs are rising. New supply chains are forming. Technological ecosystems are diverging. Finance inevitably follows these patterns. Crucially, the shift is not driven by hostility toward the United States. It is driven by a search for resilience. Countries want multiple settlement options, not because they reject the dollar, but because they do not want to be vulnerable to political disruptions or financial coercion. In many respects, this resembles the diversification of energy supplies. No country wants to rely on a single provider, especially amid rising geopolitical tensions. Thus, the trend toward multipolar currency arrangements is not a crisis. It is a structural evolution within a changing international system. The real question is not whether the dollar will remain dominant. It will, but whether the United States will adapt to a world where its financial authority is no longer exclusive. The answer to that question will define the next chapter of global economic governance. The emergence of alternative payment systems, most notably China's digital yuan, is forcing the world to confront a profound question. Has the United States, along with its Western allies, over-relied on financial coercion as a tool of foreign policy? At issue is not just strategy, but ethics. For decades, the dollar-based system functioned as a global public good, providing stability, liquidity, and trust. Yet, when a public good becomes a political weapon, the world inevitably searches for safety elsewhere. At the heart of the matter, lies a contradiction. The United States champions an open, rules-based global economy, but it simultaneously reserves the right to exclude countries from that system whenever Washington deems it necessary. Sanctions, asset freezes, banking restrictions, and swift disconnections have become routine instruments of American diplomacy. From Iran and Venezuela to Afghanistan and Russia, entire populations have seen their economic lifelines severed through financial tools designed to punish governments, but often harming civilians instead. While these measures can exert immense short-term pressure, they carry long-term costs to the credibility of the international system. Nations around the world have begun to ask a simple but destabilizing question. If our reserves, our payments, and our trade routes can be blocked at any moment by decisions made in Washington, do we truly possess economic sovereignty? This question is particularly urgent for countries that wish to pursue independent foreign policies, nations that are not adversaries of the United States, but do not wish to be entirely dependent on American goodwill. This erosion of trust is not merely geopolitical, it is moral. Finance should facilitate development, trade, and stability. It should not serve as an extension of geopolitical punishment. When the world's reserve currency becomes entangled with strategic rivalry, the global commons suffers, and when countries begin searching for alternatives, it is not because they reject cooperation with the United States, but because they fear being caught on the wrong side of a political shift. The freezing of Russia's central bank reserves in 2022 crystallized this fear. Whatever one thinks of Moscow's actions, the precedent was extraordinary. The world learned that even the sovereign reserves of a G20 country can be rendered inaccessible overnight. For many nations, especially those navigating complex regional politics, this was a wake-up call. The message was simple and chilling. Financial stability dependent on external political approval is not stability at all. China understood this moment better than anyone. The digital yuan is not a mere technological experiment. It is a direct response to a world in which Western financial power has reached its moral and practical limits. Beijing is offering an alternative whose primary appeal is not ideological alignment but insulation from vulnerability. The irony is that the United States did not have to arrive at this crossroads had Washington used its financial power sparingly, predictably, and within a clear multilateral framework. Global trust might have remained intact. Instead, decades of unilateral coercive measures have seeded doubt even among long-standing partners. The shift toward multipolar payment systems, then, is not a challenge to American values but a reaction to American overreach. It is The world's attempt to rebalance an architecture that has grown too political, too punitive, and too unpredictable. And in that sense, the movement toward alternatives, digital yuan included, reflects not anti-American sentiment, but a desire for a fairer, safer financial order. As China and Russia build a financial architecture beyond SWIFT, and as countries across Asia, the Middle East, Africa, and Latin America explore alternatives to dollar settlement, a central political question emerges. Can any American president, especially Donald Trump, reverse the accelerating trend of global de-dollarization? The honest answer is that a U.S. president can influence the trajectory but cannot reverse the underlying structural forces. The shift away from exclusive dollar dominance is not a sudden political fad. It is the outcome of deep long-term transformations that no individual leader can fully undo. These forces fall into three broad categories: technology, geopolitical fragmentation, and strategic distrust. First is the technological revolution in payments. The world is moving rapidly toward instant digital programmable money. China's digital yuan is only the first large-scale example of a central bank-issued digital currency used for international settlement. Others from India to the European Union are building their own systems. These innovations naturally diversify global finance by reducing reliance on legacy infrastructure such as SWIFT and correspondent banking. Even if Trump adopted the most dollar-friendly policies imaginable, he cannot roll back the digitalization of global finance. The technology has outrun political control. Second is the restructuring of global geopolitics. The post-TC Cold War era of unquestioned U.S. primacy has ended. Regional powers, China, India, Turkey, Brazil, Saudi Arabia, South Africa, now pursue independent economic and strategic agendas. These nations do not necessarily reject cooperation with the United States, but they refuse to operate under a system where Washington alone determines the rules. The rise of these regional centers creates multiple financial hubs, each with its own currency arrangements and settlement systems. No American president, not Trump, not Biden, not any future leader, can reassemble a unipolar world that no longer exists. Third is the erosion of global trust in U.S. financial neutrality. Decades of sanctions and asset freezes, including the immobilization of Russia's foreign reserves, have convinced many countries that the dollar system carries political risk. Trump may speak of restoring American strength, but strength rooted in coercion pushes other nations toward alternatives. Restoring trust would require a long-term reduction in the weaponization of finance, something that no president has yet achieved. Still, a president can shape the pace of change. Trump could slow de-dollarization by reducing sanctions, stabilizing relations with key partners, and encouraging investment in U.S. financial markets. He could avoid unpredictable tariff shocks that weaken global confidence. He could work with allies to modernize SWIFT and build interoperable digital payment rails, but he cannot reverse the structural transition toward a more diversified monetary order. The future is not anti-American. It is post-unipolar. The dollar will remain powerful, perhaps even dominant, but it will coexist with other systems, including China's digital yuan. The real question is not whether the world will diversify, but whether the United States can adapt gracefully to this new reality. If it does, the dollar will remain a pillar of global finance. If it does not, alternative systems will grow stronger by necessity, not by design. In this sense, the fate of dollar dominance is no longer determined solely in Washington. It is being shaped in Beijing, Moscow, Riyadh, New Delhi, Brasilia, and in the digital infrastructure that is now redefining money itself. Thank you for watching. Dash generated with https://kome.ai